Before we begin, please be aware that the content in this presentation is for informational and educational purposes only. It should not be considered as financial or investment advice. Trading foreign exchange on margin carries a high level of risk and may not be suitable for all individuals. Past performance is not indicative of future results. Please consult with a qualified professional before making any financial decisions. $6.6 trillion. That's not the U.S. national debt. That's not the value of every company in the S&P 500. That is the amount of money that changes hands every single day in the foreign exchange market. It's a number so massive it's almost meaningless. It's more than the New York Stock Exchange, the Tokyo Exchange, and the London Exchange combined and multiplied. It is the single largest, most liquid financial market on the face of the earth. And yet, for most Americans, our only exposure to it comes from some sketchy ad on social media. You know the one. Some 20-something in a rented McLaren, promising a secret algorithm, or a can't-lose robot, that will make you a millionaire overnight from your laptop. It's a world of hype, of noise, and frankly of outright deception. It's designed to make you feel like you're missing out on a secret club, and that the price of admission is buying their $1,000 course. Let's cut through all of that noise. Right here, right now. The purpose of this journey we're about to take together is to pull back the curtain on the Forex market and reveal it for what it truly is. The grand chessboard of the global economy. It's not about secret tricks. It's about understanding power, economics, and human psychology on a global scale. And for an American audience, understanding this market isn't just an academic exercise. It's about understanding the very power behind the dollar in your pocket. Every time you buy a product made overseas, fill up your car with gas, or even watch the evening news talk about trade deals with China, you are feeling the invisible currents of the Forex market. The US dollar is the world's reserve currency. It is the benchmark against which everything else is measured. So, understanding how its value shifts against the euro, the Japanese yen, or the British pound is to understand a critical piece of our own economic story. So, what is the real problem we're going to solve? We are going to demystify this $6 trillion a day behemoth. We're going to give you a framework, a set of mental models to see the market not as a chaotic, unpredictable mess, but as a complex system with underlying logic. We're not going to give you a single magic bullet strategy. Why? Because they don't exist. Instead, we're going to explore the three dominant philosophies, the three core views that professional traders, hedge funds, and even central banks use to navigate these waters. Think of them as three different detectives, all trying to solve the same mystery. Where is a currency's value going next? They each use different clues, different tools, and different logic. By the end of this series, you won't just know what they do, you'll understand why they do it. You'll be able to look at a currency chart and see it through the eyes of a fundamental analyst, a technical trader, and a quantitative strategist. And by understanding all three, you can begin to form your own informed perspective. So let's meet our first detective. This is the big picture thinker, the storyteller, the economist of the trading world. This is the fundamental analyst. The fundamental analyst believes that a currency's value is a direct reflection of the health and strength of its underlying country's economy. It's that simple and that complex. They're not obsessed with squiggly lines on a chart, at least not at first. They're obsessed with data. They're reading reports from the Federal Reserve, the European Central Bank, and the Bank of Japan. They are, in essence, giving a country's economy a full medical checkup. What vital signs are they looking for? The big ones. First and foremost, interest rates. This is the holy grail for a fundamental trader. Think of it like this. If you have a savings account, you want the one that pays the highest interest, right? Global capital works the same way. Money flows to where it can get the best return, the best yield. So when the US Federal Reserve signals that it's going to raise interest rates, it's like putting up a giant billboard that says, "Invest here for a better return." This makes the US dollar more attractive to foreign investors. They need to sell their euros, their yen, their pounds to buy US dollars to invest in US assets like bonds. What happens when demand for something goes up? The price goes up. The value of the dollar strengthens. The fundamental analysts saw this coming weeks, even months in advance. They weren't watching a 1-minute chart. They were reading the minutes from the last Federal Open Market Committee meeting. They were listening to the tone of the Fed chair's voice during a press conference in Washington, D.C., parsing every word for clues about future policy. But it's not just about interest rates. It's a whole dashboard of economic indicators. Think about the monthly jobs report, the non-farm payrolls number. A strong jobs report in the United States means the economy is humming. People are working, spending, and businesses are growing. This is a sign of a healthy economy, which makes its currency, the US dollar, more attractive. It signals stability and growth, making it a safer bet than a currency from a country with rising unemployment. Then you have inflation, measured by the Consumer Price Index or CPI. This one's a bit trickier. A little inflation is a sign of a healthy, growing economy, but too much inflation erodes the purchasing power of a currency. It means your dollar buys you less tomorrow than it does today. Central banks hate high inflation, and their primary weapon to fight it is, you guessed it, raising interest rates. So a fundamental analyst sees a high inflation report not just as a problem, but as a clue that the central bank is about to act, which brings us right back to the most important driver of them all. They also look at GDP, gross domestic product, which is the total value of all goods and services produced by a country. A country with a rapidly growing GDP is like a star company on the stock market. Everyone wants a piece of the action. This increases demand for that country's currency. And finally, the fundamental analyst is a student of geopolitics. A surprise election result, a trade war, political instability in a key region. These events can send shockwaves through the currency markets. Stability is attractive. Chaos is not. A currency from a politically stable nation like the United States or Switzerland is often seen as a safe haven during times of global turmoil. When things get scary elsewhere, money floods into the US dollar, not because the US economy is necessarily booming, but because it's seen as the safest house in a dangerous neighborhood. So, to the fundamental analyst, a currency pair like the euro to US dollar, the euro versus the US dollar, isn't just a ticker symbol. It's a story. It's the story of two massive economic blocs competing against each other in real time. Is the European Central Bank more worried about inflation than the US Federal Reserve? Is Germany's manufacturing sector outperforming America's tech sector? These are the questions that keep the fundamental analyst up at night. They piece together these macroeconomic clues to build a thesis, a core belief about which economy is on a better trajectory. Their trading decisions are the final chapter of that story. They are buying the currency of the country they believe is winning, and selling the currency of the one that's falling behind. It's a powerful, logical, and intuitive way to view the market. It connects the financial world to the real world we all live in. It's based on the cause and effect of global economics. But this approach has a glaring weakness. What happens when a country releases a fantastic jobs report, interest rates are favorable and GDP is growing, but its currency value plummets anyway? What happens when the story the data is telling you is completely ignored by the market? The fundamental analyst is left scratching their head, saying the market is being irrational. But another type of trader, our second detective, would say the market is never irrational. They believe the answer isn't buried in a government report from last month. They believe the answer, and every piece of information you could ever need, is hiding in plain sight, encoded directly onto the price chart itself. This is the world of the technical analyst, a philosophy often called technical analysis. And to its followers, it's not just a strategy. It's a worldview built on three foundational pillars. The first, as we just touched on, is that the market discounts everything. Think about that for a second. Every single piece of information, every hope, every fear, every Federal Reserve whisper, every corporate earnings report, every political scandal brewing in Washington. It's all instantly and automatically baked into the price you see on your screen. The technical analyst doesn't need to read 100 different news sources because, in their view, the collective wisdom and the collective panic of millions of traders worldwide has already done the work for them. The price of the euro against the US dollar isn't just a number. It's the final consolidated verdict of a global jury on the health of two massive economies, delivered in real time. The second pillar is that price moves in trends. This seems obvious, but it's a profound concept that forms the bedrock of this entire approach. Prices don't just flicker randomly like television static. They move with purpose. They form waves like the tide coming in and out. There are uptrends where the peaks and valleys are getting progressively higher. There are downtrends where the peaks and valleys are getting progressively lower. And there are sideways trends, where the market is catching its breath, consolidating its energy before its next big move. The job of the technical analyst isn't to predict the future with a crystal ball, but to identify the current trend, ride it like a surfer on a wave, and get off before it crashes into the shore. And the third, and perhaps most controversial pillar, is that history repeats itself. Why? Because the charts aren't just tracking numbers. They're tracking human emotion. And human nature, for all our technological advancement, remains remarkably consistent. The emotions that drove markets 100 years ago, fear and greed, are the very same emotions driving them today. The patterns that emerged from mass psychology in the past are likely to emerge again. This belief is what gives rise to the entire study of chart patterns. These visual formations, the triangles, the flags, the infamous head and shoulders, are seen not as arbitrary shapes, but as pictures of a psychological battle between buyers and sellers, a story that has played out time and time again. To really understand this mindset, we have to go back in time to the turn of the 20th century to a man named Charles Dow. You've heard his name a million times, the Dow Jones Industrial Average. But Dow wasn't just a numbers guy. He was a journalist, a storyteller, and one of the founders of the Wall Street Journal. He was obsessed with understanding the underlying health of the American economy. He saw the stock market not as a casino, but as a barometer for the entire nation's business activity. He developed a brilliant, almost common-sense theory. He created two averages. One was the industrial average, representing the big companies that made things, the manufacturing backbone of America. The other was the rail average, which later became the transportation average, representing the companies that shipped those things. Dow's logic was simple yet powerful. For the economy to be truly healthy, it wasn't enough for companies to just be making a lot of stuff. They had to be shipping that stuff to customers. If the industrials were hitting new highs, but the transports were lagging, it was a warning sign. It was like a factory producing thousands of cars that were just sitting in the parking lot, not being delivered to dealerships. It meant demand might be weakening, but when both averages were hitting new highs together, it was a confirmation. The factories were humming, and the trains and trucks were busy. The trend, he reasoned, was healthy and likely to continue. This idea of confirmation is central to technical analysis. But Dow went deeper. He observed that major market trends unfolded in three distinct phases. The first phase he called accumulation. This is the quiet part. The big economic news is still bad, public sentiment is pessimistic, and most people are steering clear of the market. But behind the scenes, the most informed investors, the smart money, are quietly buying. They see the long-term value that everyone else is missing. They are accumulating assets at bargain prices while the masses are still panicking. Then comes the second phase, public participation. This is when the trend becomes obvious. The economy starts to visibly improve. Corporate earnings pick up. The news turns positive. Technical trend followers recognize the uptrend and jump on board. This is when your friends, your family, your dentist start talking about how well the market is doing. The momentum builds as more and more people are drawn in by the rising prices. This is typically the longest of the three phases. Finally, we reach the third phase. Distribution. This is the flip side of accumulation. The news is overwhelmingly positive, even euphoric. Stories of overnight millionaires fill the media. The public is all in, buying shares with abandon, convinced the trend will go on forever. But this is precisely when the smart money, the same people who were buying in the accumulation phase, begin to quietly sell. They are distributing their holdings to the enthusiastic but late-arriving public, locking in their profits. They see the signs of excess, of irrational exuberance, and they know the party is nearing its end. Once they've finished selling, the market is left with no large buyers, and the trend reverses, often violently, catching the public by surprise. Now Charles Dow was looking at the U.S. stock market over months and years. But the psychological principles he identified are universal. They apply to any freely traded market where human emotions are in play, including the 24-hour, fast-paced world of Forex. The same patterns of accumulation and distribution, of fear and greed, play out on the currency charts, not just over years but over weeks, days, and even minutes. The tools are just more modern. Instead of just looking at price averages, today's technical analyst uses a whole arsenal of indicators to gauge the market's pulse. They use things like moving averages to smooth out price action and identify the direction of the trend. They use oscillators like the Relative Strength Index, or RSI, to measure the speed and momentum of price movements, trying to spot when a currency pair is overbought or oversold. They look at the MACD, the Moving Average Convergence Divergence, to identify shifts in momentum that might signal a trend change. To the technician, these aren't magic formulas. They are instruments like a doctor's stethoscope or an EKG. They are designed to help visualize the health and psychology of the market. They see a double top pattern on a chart, where the price hits a high level, pulls back, and then fails to break that same high level again. And they don't just see the letter M. They see the story of a market that tried to push higher, ran out of steam and was rejected. A clear sign that the sellers are gaining control. Of course, this approach has its skeptics, and their arguments are compelling. Many academics and economists subscribe to what's called the random walk theory, which posits that price changes are random and unpredictable. They argue that trying to find patterns in past price data is like seeing shapes in the clouds. It's a trick of the mind. Past performance, they say, is no indication of future results. Another major criticism is that technical analysis might just be a self-fulfilling prophecy. The argument goes like this. If thousands of traders all over the world are taught that a certain price level is a major resistance point, they will all place sell orders there. When the price reaches that level, those sell orders are triggered, pushing the price back down. The prophecy fulfilled itself. The level didn't hold because of some mystical property. It held because everyone believed it would. This leaves us at a fascinating crossroads. On one side, you have an army of traders, armed with centuries of chart data, and a belief that human psychology leaves predictable footprints. They believe the story is written in the lines on the screen. But what if the critics are right? What if the chart is just noise, the beautifully chaotic result of millions of independent decisions? What if the real story isn't in the wiggles of a line, but in the decisions being made in the halls of the Federal Reserve in Washington, D.C., or in the boardrooms of the European Central Bank in Frankfurt? What if the real power lies not in identifying what the price is doing, but in understanding the fundamental forces of why it's doing it? This is the world of fundamental analysis. It's a perspective that treats currency pairs not as squiggly lines on a screen, but as the stock prices of entire countries. If you were going to invest in a company, you wouldn't just look at its stock chart. You'd read its earnings reports, you'd analyze its management, you'd understand its position in the market. Fundamental analysis applies that same logic to nations. A country's earnings report is its economic data. Its CEO is its central bank governor. Its market position is its global economic standing. Think of it like this. Imagine two giant ships on the ocean, America and Europe. Technical analysis is like standing on the deck of the American ship, watching the waves slap against the hull, trying to predict the very next swell. It's immediate, it's close-up, and it's focused on the water right in front of you. Fundamental analysis is like being in a satellite high above the Earth. You're not watching the individual waves. You're watching the massive ocean currents, the developing weather systems, the jet streams. You see a hurricane forming 1,000 miles away that will eventually steer both ships. The fundamental analyst isn't concerned with the next small wave. They are concerned with the hurricane. They want to know where the entire ocean is heading. So, what are these giant economic currents? In the world of Forex, especially for the US dollar, there are a few titans of data that create the most powerful tides. First, and arguably the most important, is interest rates. This is the bedrock. The Federal Reserve sets the interest rate for the US dollar. Think of it as the rental fee for money. When the Fed raises interest rates, it's like a landlord increasing the rent. It makes holding that currency more profitable. Global investors, massive pension funds, and international banks are always looking for the best place to park their cash to earn a safe return. If the US offers a 5% return on its money while Japan is offering close to zero, where do you think that global capital is going to flow? It floods into the US dollar to chase that higher yield. This massive demand causes the value of the dollar to rise. Conversely, when the Fed cuts rates, the dollar becomes less attractive, and money flows out, potentially causing its value to fall. Every speech by the Fed chair, every meeting minute, is scrutinized by fundamental traders for clues about the future path of these rates. It is the single most powerful driver in the Forex market. Next up is inflation. Americans know this one intimately. It's the reason a gallon of gas or a carton of eggs costs more today than it did last year. The primary report for this is the Consumer Price Index, or CPI. For a fundamental trader, inflation is a two-sided coin. On one hand, persistent high inflation can erode the value of a currency. If your dollar buys less at home, it's seen as weaker abroad. But on the other hand, and this is the crucial part, high inflation forces the central bank's hand. It's the primary motivation for the Federal Reserve to raise interest rates. So a high inflation report can often be bullish for the dollar, not because inflation is good, but because the market anticipates the Fed will act like a hawk, raising rates to fight it, which in turn attracts foreign investment. It's a game of expectations. Then we have the health of the American worker, measured by the Non-Farm Payrolls Report, or NFP. Released on the first Friday of every month, This report is like a blockbuster movie premiere for the financial world. It shows how many jobs were added or lost in the US economy. Why does this matter for the dollar? Because a strong job market means a strong economy. More people working means more people spending, more companies growing, and more tax revenue. It's a sign of robust economic health. A healthy, growing economy gives the Federal Reserve the confidence to keep interest rates higher, or even raise them, to prevent overheating. A shockingly good jobs number can send the dollar soaring in minutes. A surprisingly bad one can cause it to plummet. It's the nation's monthly economic checkup. Finally, there's the big one, gross domestic product or GDP. This is the final grade on the country's economic report card. It's the total value of all goods and services produced. A strong, growing GDP indicates a thriving, expanding economy, which naturally attracts investment and strengthens the currency. Think of the US versus another country. If US GDP is growing at 3% and another major economy is stagnant at 0.5%, global businesses and investors are more likely to bet on American success. They will invest in US assets, and to do that, they first need to buy US dollars, driving up its value. Let's put this into a story. Imagine a fundamental trader in mid-2021. They're not glued to a 5-minute chart. They're reading reports. They see supply chain issues from the pandemic. They see massive government stimulus checks hitting bank accounts. They see the CPI numbers starting to tick up, month after month. They hear the Federal Reserve first call it transitory, but our trader is skeptical. They form a thesis, a core belief. Inflation is not transitory. It's going to get much worse, and eventually, the Fed will be forced to abandon this narrative and begin one of the most aggressive rate hiking cycles in modern history. Based on this single fundamental idea, they construct a long-term view. They believe the US dollar is set for a period of immense strength. They look at other central banks like the European Central Bank or the Bank of Japan, who are facing different problems and are not in a position to raise rates as aggressively. The trade becomes clear. Buy the US dollar against the euro and the yen. This trader isn't scalping for a few pips. They enter a position and they hold for months. When the price dips against them for a week, they don't panic. Their fundamental thesis hasn't changed. In fact, they might see it as an opportunity to add to their position at a better price. Their anchor isn't a moving average. It's their conviction in the economic narrative. Then, as 2022 unfolds, their thesis plays out. Inflation soars. The Fed pivots just as they predicted and begins hiking rates aggressively. The dollar embarks on a historic rally. Our trader wasn't reacting to the news. They were positioned for it long before it became the headline. That is the potential power of the fundamental approach. But it's not a perfect science. The biggest challenge for a fundamental analyst is that markets are not always rational. Sometimes a terrible economic report is released, and the currency against all logic goes up. Why? Because the news was less bad than the market feared. It's all about expectations versus reality. Furthermore, these trends take a very, very long time to develop. It requires incredible patience to hold a position for a year, weathering all the daily volatility, waiting for your big picture idea to come to fruition. It's a marathon, not a sprint. This raises a fascinating question. If the charts only show the past, and the economic data is so slow and often confusingly interpreted, what's left? What if the real key isn't the data itself but how the crowd feels about the data? What if the most powerful force in the market isn't interest rates or GDP, but the raw, primal, and often irrational human emotions of fear and greed on a global scale? What if you could measure the very mood of the market? Well, you can. Welcome to the world of sentiment analysis. This isn't about charts or economic reports. This is about being a market psychologist. It's the art of putting your ear to the ground and listening to the collective heartbeat of millions of traders around the world. It's about understanding that at its core, the market is a giant, chaotic, and beautiful reflection of human psychology. Imagine a colossal tug-of-war. On one side, you have the bulls, convinced the US dollar is going to soar. They are pulling with all their might, fueled by optimism and the hope of profit. On the other side, you have the bears, certain the dollar is about to tumble. They are digging their heels in, pulling with equal conviction, driven by caution or the potential to gain from a fall. The rope itself? That's the price of the dollar. Every tiny twitch, every lurch forward or backward, is the result of this epic struggle. Fundamental analysis tells you about the physical strength and conditioning of each team, their country's economic health. Technical analysis studies the history of the rope's movement, the patterns of past tug-of-war games. But sentiment analysis? It tries to read the minds of the people pulling the rope. It asks, which side is more confident? Which side is getting exhausted? Is one team overwhelmingly crowded, with no one left to join their side? Is the crowd watching the match starting to cheer louder for one team over the other? This is the third pillar of market analysis, and for many, it's the missing piece of the puzzle. Because a market can ignore strong economic data for weeks. A perfect chart pattern can fail spectacularly. Why? Because of how people feel. Because of sentiment. So how do we actually measure this? It's not like we can poll every trader on the planet. Instead, we use specialized tools that act like our own market intelligence agency, giving us clues about where the big money and the small-time traders are placing their bets. One of the most powerful tools in our arsenal, especially here in the US, is something called the Commitment of Traders Report, or the COT report. Now, that sounds incredibly boring and official, I know, but think of it as a weekly surveillance dossier delivered right to your desk by the government. Every Tuesday, the Commodity Futures Trading Commission, a US government agency, releases a report that breaks down the actual positions held by different types of traders in the futures market. It's like getting a peek at the poker hands of the most important players at the table. This report divides the market into three main groups. First, you have the commercials. These are the giants, the megacorporations like Apple, Boeing, or Cargill. They aren't in the Forex market to speculate on whether the euro will go up or down next week. They are there to hedge. They are using the market as an insurance policy. If Boeing sells a fleet of jets to a European airline for a price in euros, they need to protect themselves in case the euro weakens against the dollar before they get paid. So they'll use the futures market to lock in an exchange rate. Because they are dealing with massive, real-world business transactions, they are often considered the smart money. They have a deep, intrinsic understanding of their currency needs. Second, you have the non-commercials. These are the large speculators. Think big hedge funds, investment banks, and institutions whose primary goal is to profit from price movements. They have teams of analysts, sophisticated algorithms, and massive amounts of capital. They are the professional gunslingers of the market, and they often drive the major trends. And third, you have the non-reportable positions. This group is often used as a proxy for the small retail trader. The little guy. The crowd. So, how does this surveillance report help us? We look for extremes. We look for divergences. Imagine you pull up the COT report for the Japanese yen. You see that the commercials, the big Japanese exporters like Toyota and Sony, have built up a massive position, betting that the yen will get stronger. They're hedging their dollar-based profits. At the very same time, you see that the non-reportable traders, the retail crowd, are overwhelmingly betting the other way, thinking the yen is going to get weaker. Who would you rather side with? The multinational corporation with $1 billion reason to be right about its currency exposure, or the collective hunch of the crowd? Historically, when the retail crowd is piled in on one side of a trade and the smart money is on the other, it's a powerful signal that a major reversal could be on the horizon. The COT report is our spyglass, allowing us to see how the generals of the market are positioning their armies, long before the battle makes the headlines. But that's just one piece of the puzzle. The COT report tells us what the big players are doing. What about what the broader crowd is feeling? For this, we turn to sentiment indicators. These are tools that aggregate data from brokers and social media to give you a real-time snapshot of the market's mood. Think of it like the applause meter on a game show. Some brokers provide tools that show you, for a given currency pair like the British pound versus the US dollar, what percentage of their clients are currently long buying versus short selling. Let's say you look at this indicator and see that 90% of retail traders are long the pound. 90%. The optimism is off the charts. Everyone is on the buy side of the tug-of-war rope. Your first instinct might be to jump in with them. The crowd must know something, right? But a seasoned sentiment analyst thinks the exact opposite. They see this as a massive red flag. This is the core principle of contrarian thinking. If 90% of people have already bought, who is left to keep buying to push the price higher? The market is like a fire. It needs new fuel to keep burning. When everyone who might buy has already bought, the fuel is gone. The trade is dangerously overcrowded. At that point, the market is incredibly vulnerable. All it takes is a little bit of bad news, a slight wobble in price, and all those people who bought at the top start to get nervous. A few of them sell to lock in a tiny profit or cut a small loss. This pushes the price down a bit more. Now even more people are in the red and the panic starts to set in. The selling snowballs, creating a cascade effect as everyone rushes for the exit at the same time. The point of maximum optimism often becomes the point of maximum financial risk. Sentiment analysis teaches you to be wary of the herd. It encourages you to be the person standing quietly on the side of the road, watching where the frantic crowd is running, and preparing to go in the opposite direction. When you see extreme fear, when a currency has been pummeled for weeks and headlines are screaming that it's doomed, sentiment analysis suggests that might be the moment of maximum opportunity. When everyone who is going to sell has already sold in a panic, there are only buyers left. Now, this isn't a standalone strategy. It's not about blindly betting against the public. That's a quick way to lose your shirt. The true power comes from combining these three different views. Imagine a scenario. Your fundamental analysis of the Australian economy shows strength. Commodity prices are up, and their central bank is talking about raising interest rates. The economic story says, buy the Aussie dollar. Then you look at the charts. Your technical analysis shows the Australian dollar has just broken out of a long-term pattern and is showing strong upward momentum. The price map says buy the Aussie dollar. Finally, you check the sentiment. The COT report shows the big commercial players are increasing their long positions, and the retail sentiment indicator shows that most people are still skeptical or even shorting it. The market mood says the crowd hasn't caught on yet. That's a potential A+ setup. You have the economic engine, the clear roadmap, and the element of surprise all on your side. The three views are aligned, singing the same song. But what happens when they conflict? What if the fundamentals are strong but the charts look terrible? Or what if the charts look great, but the sentiment shows extreme, dangerous levels of greed, suggesting the move is already over? This is where the real skill comes in. It's about weighing the evidence. Sentiment analysis provides that crucial third dimension. It's the human context for the cold, hard data of economics and the historical patterns of charts. It reminds you that you aren't just trading numbers on a screen. You are trading against the hopes, fears, and biases of millions of people. So we have the economic story from the fundamentalists, the price action map from the technicians, and the market's mood from the sentiment analysts. Three powerful but distinct views. But what happens when they all point in different directions? What happens when the map says go north, the economic forecast says a storm is coming from the south, and the crowd is running west? Which voice do you trust when the market itself seems schizophrenic? That's where the real art of trading begins. The real art of trading begins not by finding the one true voice, but by learning to conduct the orchestra. Because these voices, the technical charts, the fundamental economic reports, and the roar of market sentiment, aren't actually in conflict. They're just different instruments playing different parts of the same complex symphony. The problem is, most people only learn to listen to one instrument. The technical trader hears only the violins of the price chart, ignoring the thundering drums of a Federal Reserve announcement. The fundamental purist listens only to the brass section of GDP reports and inflation data, blind to the quiet melody of a developing chart pattern that signals the music is about to change. And the sentiment follower is just listening to the applause, trying to guess which way the crowd will cheer next. The true craft is in understanding how they harmonize, how a shift in the economic fundamentals can change the key of the entire piece, and how the technical charts show you the exact notes being played moment by moment. This is where we move from being a simple analyst to a strategist. Think of it like planning a major business expansion in the United States. Your fundamental analysis is your market research. It's looking at the demographics of a new city, the economic health of the region, the long-term industry trends. This is your big picture strategic why. You wouldn't open a luxury car dealership in a town with a declining economy, no matter how good the real estate deal looks. For a Forex trader, this is asking, is the US economy fundamentally stronger than Japan's? Is the Federal Reserve on a path of raising interest rates while the European Central Bank is cutting them? This gives you a directional bias, a long-term thesis. For example, your fundamental view might be, over the next 6 months, the US dollar is likely to strengthen against the Japanese yen. That's your strategic objective. But a strategic objective is not a plan of action. That's where technical analysis comes in. This is your operational plan. It's the equivalent of scouting specific locations in that new city. You've decided the city is a good market. Now you need to find the right street corner. Is there good traffic flow? Is it easily accessible? What's the price per square foot? On a Forex chart, this means looking at the dollar-yen pair and asking, where are the key levels of support and resistance? Is the price currently in an uptrend or a downtrend? Is it forming a pattern that suggests a continuation of the trend? Or a reversal? Your fundamental analysis gave you the what? By the dollar against the yen. Your technical analysis tells you the when and where. It helps you pinpoint a specific entry price, a place to set a stop loss to manage risk if you're wrong, and a potential target for taking profits. A professional doesn't just buy the dollar. They might say, I will look to buy the dollar-yen pair if it pulls back to the 148.50 support level, which has held 3 times before, and shows a bullish candlestick pattern. See the difference? It's the shift from a vague idea to a precise, actionable tactic. Now what about the third voice, the crowd? Market sentiment. This is your on-the-ground intelligence. It's like checking the local news and social media before your grand opening. Is there a buzz? Are people excited? Or is a local competitor running a massive smear campaign against you that your big-picture research missed? In trading, sentiment analysis can be a powerful confirmation tool or a critical warning sign. If your fundamental and technical analyses both suggest the euro is going to fall, and you see that sentiment indicators show traders are overwhelmingly bearish on the euro, it can add conviction to your trade. It tells you that a lot of other people are seeing what you're seeing. But it can also be a potent contrarian signal. This is a more advanced concept, but it's crucial. Markets are famous for pushing things to irrational extremes. If literally everyone, from Wall Street analysts to your cousin who just started trading, is screaming that the dollar is going to the moon, that might be the exact moment the market is about to reverse. This is called a crowded trade. When everyone is already on one side of the boat, who is left to keep pushing it in that direction? A sudden piece of news can cause a panic, and everyone rushes to the other side, causing a violent swing in the opposite direction. So a strategist uses sentiment not just to follow the crowd, but to measure its insanity. When the crowd is euphoric, the strategist gets cautious. When the crowd is in absolute despair, the strategist starts looking for opportunities. The integration of these 3 views is what we call a hybrid approach, and it's the foundation of most sophisticated trading operations. It's not about choosing one over the others, it's about creating a hierarchy. A common framework used by institutional traders is to let fundamentals dictate the long-term direction, use technicals to time the entries and exits for specific trades, and employ sentiment as a final filter or reality check. This creates a robust, 3-dimensional view of the market. It's the difference between navigating with a single blurry map and using a high-resolution satellite image overlaid with real-time traffic and weather data. You see the whole picture: the landscape, the roads, and the flow of cars. So how do you, as an individual trader, build this for yourself? You do it by creating what I call a personal trading doctrine. This isn't just a vague idea in your head. It's a written document, a constitution for your trading business. It's your personal rulebook that governs every single decision you make. It's what you turn to when the market is chaotic, your emotions are running high, and those 3 voices are screaming at you. Your doctrine is the calm, rational voice of the strategist you were when you had time to think clearly. This doctrine would explicitly state your philosophy. For example, it might say, my approach is fundamentally driven and technically executed. I will only take trades that align with my long-term macroeconomic view. My primary fundamental drivers will be interest rate differentials and GDP growth. I will use daily and 4-hour charts to identify entry points at key support and resistance levels. I will use the commitment of traders report as my primary sentiment gauge. And I will be cautious of entering new long positions when large speculators are at a historical extreme. This document then gets even more specific. It details the exact currency pairs you will trade. Maybe you decide to only focus on the major pairs involving the US dollar because that's the economy you understand best. It specifies your risk management rules, the absolute maximum percentage of your capital you are willing to risk on a single trade, without exception. It defines what a high probability setup looks like to you. It might be a checklist. Is the trade aligned with the fundamental direction? Yes. Is it at a predefined technical level? Yes. Is sentiment confirming or at a contrarian extreme? Yes. If all the boxes aren't checked, you don't take the trade. Period. No negotiation. No gut feelings. This process transforms trading from a gambling exercise into a professional discipline. A gambler walks up to the table and throws chips down based on a hunch. A professional trader consults their business plan, waits for conditions that meet their strict criteria, and executes with precision. The trading doctrine is your business plan. It's what forces you to be consistent. Without it, on a Monday you might be a technical trend follower, on Tuesday a fundamental news trader, and on Wednesday a sentiment-based contrarian. This inconsistency is a recipe for failure, because you never know if your wins or losses are due to skill or luck. You have no process to refine, no data to review. With a doctrine, you have a baseline. After a month of trading, you can go back and review every single trade. Did you follow your rules? When you followed them, what was the outcome? When you broke them, what happened? This is how you improve. You're no longer just reacting to the market's noise. You're running a system, gathering data, and optimizing your performance. You are the CEO of your own trading business, and your doctrine is the corporate charter that guides the entire enterprise, ensuring it doesn't get sidetracked by short-term market madness or emotional impulse. This is the single greatest bridge between being a market hobbyist and a market operator. And it all starts with learning to listen not just to one instrument, but to the entire symphony. So what are the instruments in this grand market symphony? They aren't violins and cellos. They are stocks, bonds, and commodities. And for an American trader, understanding how these seemingly separate worlds interact with the US dollar is like having a backstage pass to the global economy. It's the difference between hearing a single note and understanding the entire chord progression. This is the world of intermarket analysis, and it's where the most insightful trading ideas often begin. It's about building a case like a detective, using evidence from multiple sources before ever coming to a conclusion about a currency pair. Let's start with the most important, yet often overlooked, section of the orchestra: the bond market. Specifically, U.S. Treasury bonds. If the market were a living organism, the bond market would be its central nervous system. It's the smart money sector, where giant institutions place colossal bets on the future of interest rates, inflation, and economic growth. For a Forex trader, the key metric to watch is the yield on U.S. Treasury bonds, particularly the 10-year Treasury note. Think of it this way. A country's government bond yield is like the interest rate it offers to the world. If the U.S. 10-year yield rises, it means investors are getting a better return for lending money to the U.S. government, one of the safest investments on the planet. This higher return acts like a powerful magnet for global capital. A fund manager in Tokyo or London sees that they can get a higher, safer return in the U.S. than they can at home. What do? They sell their local currency, be it yen or pounds, and buy U.S. dollars to purchase these higher-yielding U.S. bonds. This massive inflow of demand for dollars naturally pushes the value of the dollar up. Conversely, if U.S. bond yields fall, the dollar becomes less attractive, and capital may flow out, weakening the currency. This isn't a theory. It's the fundamental plumbing of global finance. Watching the direction of U.S. Treasury yields often gives you a powerful leading indicator for the potential direction of the U.S. dollar index, or DXY. It's the market's way of pricing in future moves by the Federal Reserve, often months in advance. Next, let's turn to the section of the orchestra that gets all the media attention: the stock market. The Dow Jones, the S&P 500, the Nasdaq. This is the roaring crowd, the pulse of investor sentiment. The relationship here is a bit more nuanced than with bonds. It all comes down to two key concepts: risk on and risk off. When U.S. stock markets are soaring, it typically reflects a risk-on environment. Investors are optimistic, confident in economic growth, and willing to buy riskier assets like stocks for higher potential returns. How this affects the dollar can go one of two ways. On one hand, a booming U.S. stock market can be a symptom of a strong U.S. economy, which is fundamentally bullish for the U.S. dollar. International investors pour money into American companies, buying dollars to do so. However, there's another side to the coin. During a global risk-on phase, that same optimism might lead investors to sell the U.S. dollar, which is traditionally seen as a safe haven currency, and buy currencies of countries with higher growth potential or higher interest rates. Think the Australian or New Zealand dollar. They're selling safety to chase yield. The opposite is the risk-off environment. When stocks are plummeting, fear takes over. Investors flee from risky assets and scramble for safety. And what are the world's primary safe havens? The US dollar, the Japanese yen, and the Swiss franc. In times of global panic or uncertainty, you'll often see a stampede into the dollar, regardless of what the US economy is actually doing. The dollar becomes a global storm shelter. So by watching the stock market, you're not just watching corporate profits, you're taking the temperature of global investor fear and greed, which is a massive driver of currency flows. Finally, we have the raw foundational layer of the global economy: commodities. The prices of things we pull from the ground: oil, gold, copper. tell a powerful story that directly impacts certain currencies. These are known as commodity currencies. For the American trader, two relationships are absolutely critical to understand. First is the price of crude oil and its relationship with the Canadian dollar. This means paying close attention to the US dollar to Canadian dollar pair. Canada is one of a handful of major, developed economies that is also a massive net exporter of energy. Its economic health is intrinsically linked to the price of oil. When oil prices rise, Canada gets paid more for its primary export. This influx of foreign currency to buy Canadian oil strengthens the Canadian economy and, consequently, the Canadian dollar. As a result, when oil goes up, the US dollar to Canadian dollar pair tends to go down because the CAD is getting stronger relative to the USD. When oil prices fall, the opposite often happens. This inverse correlation is one of the most reliable intermarket relationships in Forex. The second is the classic dance between gold and the US dollar. Gold is the ultimate anti-currency. It has been a store of value for millennia, and it pays no interest. People own it for one primary reason: as a protection against the debasement of paper currencies and against uncertainty. Because the US dollar is the world's reserve currency, gold often has a strong inverse relationship with it. When investors lose faith in the dollar, perhaps due to fears of high inflation or massive government debt, they often turn to the perceived safety of gold. This means a rising gold price can be a signal of a weakening dollar. Conversely, a strong, high-interest rate dollar makes gold less attractive, as gold offers no yield. Watching the price of gold gives you a real-time gauge of global anxiety and faith in the US dollar itself. So how does a trader use all this? Let's build a case. Imagine you're looking at the euro to US dollar chart, and it looks like it's starting to trend down. Instead of just relying on a technical indicator, you become a detective. You look at the bond market. US 10-year Treasury yields are spiking higher while German 10-year bond yields are falling. That's piece of evidence number one: capital is flowing from Europe to the US for better returns. A huge negative for the euro and positive for the dollar. Then you check the stock market. The S&P 500 is in a strong uptrend. This signals a risk-on mood, but the money is clearly favoring US assets. Evidence number two. Finally, you look at commodities. Gold has been selling off, suggesting investors aren't worried about the dollar's value and prefer the yield offered by US bonds. Evidence number three. Suddenly, the downtrend on your euro to US dollar chart isn't just a pattern of lines. It's the logical conclusion of a global story, a story of capital rotating into the United States. You now have a fundamental, multifaceted thesis backing your analysis. This approach doesn't offer certainty, but it offers something far more valuable: conviction. It helps you understand the powerful tides moving the market, allowing you to align your strategy with the dominant capital flows, rather than trying to swim against them. This is the shift from seeing the market as a random walk to seeing it as a complex but logical ecosystem. And the key to navigating that ecosystem is knowing which economic reports are causing these very shifts in bonds, stocks, and commodities in the first place. So let's pull back the curtain on the very data that Wall Street, central bankers, and professional traders obsess over. Think of these economic reports as the market's vital signs. Just as a doctor checks your heart rate and blood pressure to assess your health, traders analyze this data to assess the health of an economy. And for the US market, some vital signs are far more important than others. At the absolute top of the pyramid, the heavyweight champions of economic indicators are what we can call the Big Three. These are the reports that can stop the market in its tracks, create massive waves of volatility, and completely reshape the narrative for the weeks and months ahead. If you understand these three, you understand the core drivers of the US dollar. First, and arguably the most watched single piece of data, is the Non-Farm Payrolls Report, or NFP. Released on the first Friday of every month by the Bureau of Labor Statistics, this report is a blockbuster. It measures the number of jobs added or lost in the US economy over the previous month, excluding farm workers, government employees, private household employees, and nonprofit workers. Why is this one number so powerful? Because employment is the bedrock of the American economy. More people working means more people have paychecks. More paychecks mean more consumer spending. And consumer spending is the engine that drives over 2/3 of the US economic activity. A strong NFP number, meaning more jobs were created than expected, is often interpreted as a sign of a robust, growing economy. This can lead to speculation that the Federal Reserve, America's central bank, might raise interest rates to keep the economy from overheating and to control inflation. Higher interest rates make a currency more attractive to foreign investors seeking a better return on their money. They essentially sell their currency to buy US dollars to invest in US assets, which can drive the value of the dollar up. Conversely, a weak NFP number, with fewer jobs than expected or even job losses, signals economic trouble. It suggests consumers might pull back on spending, businesses might slow down, and it could pressure the Federal Reserve to lower interest rates to stimulate the economy. Lower interest rates can make the US dollar less attractive, potentially causing its value to fall. The NFP release isn't just a number. It's a monthly referendum on the health of Main Street America, and the markets react accordingly. The second member of our Big Three is the Consumer Price Index, or CPI. If NFP tells us about the health of the job market, CPI tells us about the cost of living. It measures the average change over time in the prices paid by urban consumers for a basket of consumer goods and services, everything from gasoline and groceries to rent and healthcare. In simple terms, it's the most widely followed measure of inflation. And in the world of central banking, inflation is public enemy number one. The Federal Reserve has what's called a dual mandate: to achieve maximum employment and to maintain price stability. That price stability part is all about keeping inflation in check, typically around a 2% target. When the CPI report comes out and shows inflation is running hot, meaning prices are rising faster than that target, it sets off alarm bells that the federal persistent high inflation erodes the purchasing power of the dollar. Your money simply buys less than it used to. To combat this, the Fed's primary tool is raising interest rates. Higher rates make borrowing money more expensive, which cools down demand and, in theory, brings prices back under control. For Forex traders, a higher-than-expected CPI reading can immediately trigger bets that the Fed will act aggressively, leading to a potential surge in the dollar's value. A lower-than-expected CPI reading suggests inflation is tame, giving the Fed room to keep rates low or even cut them, which could have the opposite effect on the dollar. Understanding CPI is understanding the primary justification for the Fed's most powerful market-moving decisions. And that brings us to the third and most direct of the Big Three, the Federal Open Market Committee, or FOMC statement. This isn't just a report, it's the main event. 8 times a year, this committee of 12 Federal Reserve officials meets to decide the path of monetary policy for the United States, including the single most important number in global finance, the federal funds rate, which is the target interest rate. The NFP and CPI are the data points the FOMC studies. The FOMC statement is their verdict. The release of the FOMC statement is a multi-stage drama. First, the written statement itself is released, which includes the interest rate decision. The market almost always has a strong expectation of what the decision will be. The real volatility often comes from the language in the statement. Traders and algorithms scan every single word, looking for subtle changes from the previous statement. Did they describe economic growth as strong instead of moderate? Did they add or remove a single sentence about inflation risks? These tiny linguistic shifts can signal a major change in future policy and send currencies flying. Then, about 30 minutes later, the Fed chair holds a press conference. This is where the market hangs on every word, every nuance, every hesitation. The chair's answers to reporters' questions provide crucial context and can either confirm the market's interpretation of the statement or completely upend it. The FOMC is the ultimate source of truth for the direction of U.S. interest rates, and therefore, the long-term direction of the U.S. dollar. Beyond these three titans, there's a second tier of highly influential reports that fill in the details of the economic picture. Think of retail sales. This report tracks the total value of sales at the retail level. It's a direct look at the consumer spending that NFP hints at. If retail sales are strong, it confirms the economy is humming. If they're weak, it's a red flag that consumers are closing their wallets, which is a major concern for an economy built on consumption. Then there's the gross domestic product, or GDP. This is the broadest measure of economic health, representing the total monetary value of all goods and services produced within the country over a specific time period. It's the economy's official report card. While it's incredibly important, it's often less of a market mover on its release day than the others. Why? Because it's a lagging indicator. The GDP report for the first quarter, for example, is released at the end of April, telling us what happened from January to March. By that time, traders have already seen 3 NFP reports, 3 CPI reports, and multiple other data points, so they often have a very good idea of what the GDP number will be. A big surprise can still cause a stir, but it's more of a confirmation of a trend than a breaking news event. Finally, we have sentiment indicators like the Consumer Confidence Index. This report is based on a survey that asks people how they feel about the current and future state of the economy and their own personal financial situation. It's a measure of economic psychology. An optimistic consumer is more likely to make big purchases, take vacations, and invest. A pessimistic consumer is more likely to save money and cut back on spending. While it's a soft data point compared to the hard numbers of jobs or sales, it provides a valuable forward-looking glimpse into the mindset of the very people who power the economy. A sudden drop in confidence can be an early warning sign of an economic slowdown, long before it shows up in the GDP or NFP figures. Each of these reports, from the titans like NFP to the psychological barometers like consumer confidence, is a piece of a massive interlocking puzzle. They don't exist in a vacuum. A strong jobs report might be offset by a weak inflation reading. Strong retail sales might be tempered by a hawkish tone from the FOMC. Learning to read these reports isn't just about knowing if the number is good or bad. It's about understanding what that number means within the broader context of all the other data, and most importantly, how it might influence the future decisions of the Federal Reserve. This is the language the market speaks, and fluency begins with understanding its core vocabulary. So let's expand that vocabulary. If non-farm payrolls and the Consumer Price Index are the main characters in our economic story, then the supporting cast is just as crucial for understanding the plot. The market doesn't just listen to the headlines. It reads the entire report, footnotes and all. It's about understanding the difference between a leading indicator and a lagging indicator. Think of it like driving a car. Your speedometer tells you how fast you're going right now. That's a lagging indicator. It confirms your current state. But your GPS, warning you of a traffic jam 5 miles ahead? That's a leading indicator. It gives you a glimpse into the future, allowing you to potentially adjust your course. In economic terms, a lagging indicator like the official gross domestic product or GDP figure tells you what has already happened. It's the final report card for the previous quarter. It's incredibly important for confirming long-term trends, but by the time it's released, the big money has often already positioned itself based on what it thought the report card would say. Leading indicators, on the other hand, are the forward-looking clues. They are the surveys, the sentiment readings, and the new orders that hint at where the economy is headed. For a fundamental analyst focused on the US dollar, these are the breadcrumbs that lead to a potential trading thesis. Let's look at a few of the most powerful ones. First up is the ISM Manufacturing and Services PMI, which stands for the Purchasing Managers Index. This is a huge one. Imagine you could survey hundreds of purchasing managers at major companies across the country every single month. You'd ask them, are you hiring more people? Are your new orders up or down? Are you paying more for supplies? Is your backlog of work growing? Their collective answers give you a real-time, on-the-ground snapshot of the health of the business sector. The PMI is presented as a number, and the magic line in the sand is 50. A reading above 50 suggests that the manufacturing or services sector is expanding. A reading below 50 suggests it's contracting. Why is this so powerful? Because these purchasing managers are at the coalface of the economy. They see changes in demand before they ever show up in a government GDP report 3 months later. If businesses are ramping up orders and production, that often precedes hiring more workers and stronger overall economic growth. A string of strong PMI readings can be a powerful tailwind for the US dollar, as it signals underlying economic strength that could keep the Federal Reserve in a hawkish rate-hiking mood. Next, let's talk about consumer sentiment. There are 2 big reports to watch here: the University of Michigan Consumer Sentiment Index and the Conference Board's Consumer Confidence Index. They essentially measure the same thing. How do average American households feel about their own financial situation and the economy at large? It might sound a bit abstract, but it has profound implications. Consumer spending accounts for roughly 70% of the US economy. It is the engine. And what drives that spending? Confidence. If people are confident about their job security and future prospects, they're more likely to go out and buy a new car, renovate their kitchen, or take a vacation. If they're fearful and uncertain, they save their money, pay down debt, and cut back on discretionary spending. These confidence reports are leading indicators because they measure the intention to spend. A sharp drop in consumer confidence can be an early warning sign that retail sales and eventually GDP are about to weaken. Conversely, a surge in confidence can signal that the economic engine is firing on all cylinders. The market watches these numbers closely because a confident consumer is a spending consumer, and as spending consumer powers the U.S. economy. Another, often overlooked, leading indicator is building permits. Why? Because construction is a massive economic multiplier. A new housing development doesn't just create jobs for construction workers. It creates demand for lumber, copper wiring, furniture, and appliances. It requires real estate agents, mortgage brokers, and landscapers. A rise in the number of permits issued for new construction is a powerful vote of confidence in the future of the economy. It tells you that builders are willing to invest significant capital based on the belief that there will be buyers for those homes in the months and years to come. It's a forward-looking indicator of investment, job creation, and economic activity. Now let's circle back to the lagging indicators. As mentioned, GDP is the ultimate lagging indicator. It's the sum total of all goods and services produced, and it's the most comprehensive measure of economic health. But it's released quarterly and reflects the past. So why do we care? Because it confirms the narrative. If the leading indicators like PMI and consumer confidence have been strong for months, a solid GDP number validates that story. If it comes in surprisingly weak, it forces everyone to question whether the optimism was misplaced. Even the unemployment rate, which comes out with the NFP report, can be considered a lagging indicator. Think about the business cycle. A company doesn't lay off workers the moment they see a slight dip in sales. They first try to cut costs elsewhere. Layoffs are often a last resort, happening only after a period of sustained weakness. Therefore, a rising unemployment rate often confirms that a slowdown is already well underway. So, how does a trader synthesize all this information? This is the art of fundamental analysis. It's not about reacting to a single number. It's about building a mosaic. You're looking for confluence, for multiple data points to be telling you the same story. Let's paint a picture. Imagine for the past 3 months, the ISM PMI has been climbing from 52 to 55. Consumer confidence has been steadily rising. Building permits are ticking up. These are your leading indicators, your GPS, all telling you that the road ahead looks clear and the economy is accelerating. Based on this, you might form a bullish bias on the US dollar. You hypothesize that this underlying strength will eventually force the Federal Reserve to keep interest rates higher for longer to combat any potential inflation, making the dollar more attractive to foreign investors. Then the NFP report comes out. The market was expecting 200,000 jobs to be added. The report prints at 250,000. This is the catalyst. It's the piece of hard data that confirms the story the leading indicators have been telling. The market sees this, the probability of future rate hikes increases, and the dollar strengthens. But what if the opposite happens? What if PMI has been trending down, consumer confidence is falling, and then the NFP report badly misses expectations? This confluence of negative data paints a bearish picture. It suggests the economy is slowing, which might lead the Federal Reserve to consider cutting interest rates in the future, a scenario that would likely weaken the dollar. The key is to understand the interplay between expectations and reality. The market is a giant expectations machine. It's always trying to price in the future. A good number isn't necessarily good for a currency if the market was expecting an excellent number. For example, if GDP was forecast to grow at 3% and it only grows at 2.5%, that 2.5% is still healthy growth. But because it missed the forecast, it's a disappointment, and the currency could sell off. The reaction is not to the data itself, but to the data relative to expectations. For the American trader, this dashboard of economic indicators provides the fundamental narrative for the US dollar. By tracking these releases, understanding whether they are leading or lagging, and seeing how they fit together, you can build a logical data-driven thesis for why the dollar might strengthen or weaken against other currencies. This isn't about predicting the future with a crystal ball. It's about assessing probabilities. It's about understanding the economic story that is unfolding, chapter by chapter, with each new data release. This fundamental view gives you the why. It helps you understand the underlying forces that can create large, sustained trends in the currency market. It's the foundation upon which a durable trading perspective is built. But knowing why a currency might move is only half the battle. The other half is knowing when and where it might move. And for that, we have to turn our attention from the economic calendar to the price chart itself. This is where the entire game changes for many people. It's where the abstract world of economic reports and central bank statements gets translated into a visual language. Welcome to the world of technical analysis. At its heart, technical analysis is the study of price movement. It operates on a few core beliefs that have been debated for decades, yet form the foundation for countless trading strategies. The first belief is that the price discounts everything. This is a powerful idea. It means that any and all relevant information, from an NFP report to a surprise interest rate hike to geopolitical tensions, is already reflected in the current price on your chart. A technical analyst believes that instead of trying to analyze a million different fundamental factors, you can just analyze one thing, the price itself, because it's the final distilled output of all those factors combined. The chart, in essence, is the truth. The second belief is that prices move in trends. An object in motion tends to stay in motion, and the same principle is often applied to financial markets. Currencies don't just jump around randomly. They tend to move in discernible directions for periods of time. They trend up, they trend down, or they move sideways in a range. The job of the technical analyst is to identify the current trend as early as possible and ride it, on the assumption that the trend is more likely to continue than to reverse. And the third, and perhaps most important belief, is that history tends to repeat itself. This isn't about magic. It's about human psychology. The financial markets are driven by people, and people tend to react to similar situations in similar ways. Fear, greed, hope, and uncertainty are timeless emotions. Because of this, certain chart patterns and price behaviors that have occurred in the past are likely to reoccur in the future. Technical analysis is the art and science of identifying these recurring patterns to gain an edge. So, how do they do it? The primary tool is the price chart itself, most commonly the candlestick chart. Think of each candlestick not as a random bar, but as a miniature story of a battle between buyers and sellers over a specific period, be it 1 minute, 1 hour, or 1 day. The body of the candle tells you if the buyers, bulls, or the sellers, bears, won that battle. A green or white candle means the price closed higher than it opened. The buyers were in control. A red or black candle means the price closed lower. The sellers dominated. The little lines sticking out the top and bottom, called wicks or shadows, show you the full territory that was fought over, the absolute highest and lowest prices reached during that period. By stringing these stories together, you start to see the entire narrative of the market unfold. From this foundation, we get to the most fundamental concepts in technical trading: support and resistance. Imagine you're in a room with a floor and a ceiling. You drop a ball. It bounces off the floor and flies up towards the ceiling. It hits the ceiling and falls back down. The floor is your support level. It's a price level where buying pressure has historically been strong enough to overcome selling pressure and push the price back up. It's a point where the market perceives the currency as a good value, and buyers step in. The ceiling is your resistance level. It's a price level where selling pressure has historically overwhelmed buying pressure, causing the price to turn back down. It's where the market starts to think the currency is overvalued, and sellers take control. These levels are powerful because they are often self-fulfilling. Traders all over the world see these same floors and ceilings on their charts. So when the price approaches a known support level, many traders place buy orders, adding to the buying pressure and helping to create the very bounce they were anticipating. It's a fascinating look into crowd psychology at a global scale. To see the bigger picture, traders draw trend lines. By connecting a series of higher lows in an uptrend, or lower highs in a downtrend, they create a visual guide to the market's direction. A break of a long-standing trend line can be a significant signal that the entire market dynamic might be shifting. But price can be noisy. To smooth out the day-to-day volatility and see the underlying trend more clearly, traders use indicators, with the most common being moving averages. A moving average simply calculates the average price of a currency over a specific number of periods, say the last 50 days or 200 days. It's plotted as a single, flowing line on the chart. Think of it as the market's center of gravity. When the price is trading above its moving average, the sentiment is generally considered bullish. When it's below, it's bearish. The 200-day moving average, in particular, is one of the most widely watched technical indicators in the world, not just in Forex but in stocks and commodities too. Major institutional players pay close attention to it. Beyond trend-following tools, there are also oscillators, which help gauge the momentum of price movements. The Relative Strength Index, or RSI, is a popular one. It measures the speed and change of price movements on a scale of 0 to 100. It doesn't tell you what the trend is, but it tells you how strong it is. Conventional wisdom suggests that a reading above 70 indicates a currency might be overbought and due for a pullback, while a reading below 30 might suggest it's oversold and could be due for a bounce. It's like a speedometer for the market. Now, it's crucial to understand this. Many academics and fundamental purists dismiss technical analysis as nothing more than financial astrology, finding patterns in random noise. And to be fair, if used improperly, it can be. There is no single indicator or pattern that can predict the future with 100% accuracy. If there were, everyone would use it and it would cease to work. The true value of technical analysis isn't in prediction, but in risk management and probability. Provides a framework. It allows a trader to look at a chart and say, based on historical price behavior, this is a high probability area for the market to turn. Or, if the price breaks below this support level, my thesis for this trade is likely wrong, and I should exit to limit my potential loss. It provides defined entry and exit points. It takes the guesswork and raw emotion out of the equation and replaces it with a structured, rules-based approach. But here is the secret that the most seasoned market participants understand. The debate between fundamental and technical analysis is a false choice. You don't have to pick a side. In fact, the most robust approaches often use both in harmony. They create a powerful synergy. Think of it this way: fundamental analysis tells you the story. It answers the question, why should I trade this currency? Maybe the Federal Reserve is signaling aggressive rate hikes, creating a fundamentally strong case for the US dollar. That's your long-term bias. That's your why. Then, technical analysis provides the timing. It answers the question, when and where should I execute this trade? You might have a great fundamental reason to buy the dollar, but the chart shows it's currently at a major resistance level after a huge run-up. A technical approach would suggest waiting for a pullback to a key support level or a moving average before entering. This allows you to enter the trade at a better price, and with a more defined risk level. The fundamentals gave you the reason to get in the car, and the technicals gave you the roadmap and told you when to hit the gas. By combining the why of fundamentals with the when and where of technicals, a trader can build a comprehensive view of the market. They understand the underlying economic drivers pushing a currency, and they can use the chart to find strategic points to act on that view, all while managing their risk with precision. So we have the why from our fundamental view, and the when and where from our technical view. But even with the most perfect analysis, there's one final critical piece of the puzzle that separates successful approaches from the rest. It's the one element that governs everything else, and it has nothing to do with the charts or the news. It has to do with what's going on between your ears. It's the ultimate paradox of trading. You can have the most sophisticated charting software, access to institutional-level news feeds, and a strategy with a 70% historical win rate, and still lose money consistently. Why? Because the market has a direct line into the most primitive parts of your brain, the parts that evolved for survival on the savannah, not for navigating the fluctuations of the dollar-yen. This internal battle is the great filter. It's the reason you hear statistics like the 90-90-90 rule, that 90% of new traders lose 90% of their capital within the first 90 days. That isn't an indictment of their strategies. It's an indictment of their inability to manage the one variable they actually have total control over, themselves. Every trader, from the rookie opening their first account in their Chicago apartment to the seasoned pro managing millions from a New York office, is constantly fighting a war on two fronts. But it's not against bulls and bears. It's against two much more powerful forces: fear and greed. Think of them as two wolves living inside you. The first is the wolf of greed. This is the one that whispers in your ear when a trade is going your way. Look at that. It's running. Don't take profit yet, this could be the big one. Add to your position. Mortgage the house. Greed is what turns a solid winning trade into a losing one. It convinces you to abandon your take-profit levels, hoping for a home run. It pushes you to over-leverage, risking a catastrophic amount of your capital on a single idea, because the allure of a massive payday short-circuits all rational thought. Greed is what makes you chase the market, entering a trade long after the ideal entry point has passed, simply because you can't stand to watch the train leave the station without you. This is FOMO, the fear of missing out, and it's just greed wearing a clever disguise. Then you have its twin, the wolf of fear. This wolf is even more insidious. Fear is what makes you see a perfect trade setup, one that fits every single rule in your meticulously crafted plan, and you freeze. You hesitate. You second-guess. You wait for just one more confirmation candle, and by the time it appears, the opportunity is gone. Fear is also what makes you snatch a tiny profit off the table, cutting a potential winner short because you're terrified of it turning around and becoming a small loss. You end up with a dozen tiny wins and one or two catastrophic losses that wipe out all your progress, Because the wolf of greed was driving when you let those losers run. Fear makes you panic sell at the bottom and panic buy at the top. It convinces you that this time is different, that your stop loss is in a bad spot. And you move it just this once, violating the one rule designed to protect you from ruin. So which wolf wins? The one you feed. Discipline is how you starve them both. A trading plan isn't just a set of rules for entry and exit. It's a constitution. It's a pre-commitment you make to your rational, intelligent self to be executed when your emotional, impulsive self tries to take the controls. It's you in a moment of calm clarity, telling your future, panic self exactly what to do. You must follow it. Not most of the time. All of the time. The moment you deviate, you've fed one of the wolves, and it will only grow stronger. This is particularly challenging in the American cultural landscape. We are a nation built on ambition, on hustle, on the idea of going for it. We celebrate the risk takers who bet big and win. This mindset can be a powerful engine for entrepreneurship, but it can be pure poison in the trading arena. Trading isn't about hitting a grand slam. It's about hitting single after single with the occasional double, and rigorously avoiding the strikeouts that take you out of the game. It's a business of probabilities and risk management, not a slot machine in Vegas. The goal is not to get rich this week. The goal is to still be in the game next year. And the year after that, with a steadily growing equity curve. It is a marathon of 1,000 small disciplined steps, not a 100-yard dash. So how do you build this mental fortress? How do you train yourself to be the calm operator in the middle of a storm of flashing red and green lights? First, you become a scientist of your own behavior. Start a trading journal, but don't just log your entries, exits, and profit or loss. That's the easy part. Log your emotions. Before you enter a trade, write down why. I am taking this trade because it meets rules A, B, and C of my plan, and I feel calm and objective. Or be honest. I am taking this trade because I'm bored and the market is moving, and I feel anxious about missing out. When you close the trade, log your feelings again. I closed the trade at my profit target as planned. Or, I panic closed it for a small loss because I got scared by a news headline. After a few weeks, this journal will be more valuable than any trading book. It will show you a mirror of your psychological weaknesses. It will reveal the wolf you feed most often. Second, you build unshakable confidence in your system, not in your gut feelings. The way you do this is through backtesting and forward testing. By manually going through historical charts and testing your strategy over hundreds, even thousands of past setups, you gather statistical data. You will know your system's historical win rate, its average risk-to-reward ratio, its maximum drawdown. This data is your shield. When you're in a live trade and the wolf of fear starts whispering, you can look at your data and say, I know this system has a 60% win rate over the last 500 trades. I don't know if this trade will be a winner, but I know if I execute my plan flawlessly over the next 100 trades, the probabilities are in my favor. This transforms trading from a guessing game into a statistical operation. Third, you practice in the right environment. Start with a demo account, and your only goal should be flawless execution of your plan. Not making money, just following the rules. Once you can do that for a month straight, move to a live account with the smallest possible position size. We're talking microlots where you're risking pennies per trade. The goal, again, is not to make money. It's to get used to the psychological pressure of having real, albeit small, money on the line. You are training your emotional muscles. You wouldn't walk into a gym and try to bench press 400 pounds on your first day. You start with the bar. Trading is no different. Over these 10 parts, we've journeyed through the entire landscape of Forex trading. We've looked at the fundamental drivers, the economic heartbeat of nations, controlled by central banks. We've dissected the charts, learning the language of price action through technical analysis. We've explored quantitative approaches and the rise of algorithmic trading. We've weighed the pros and cons of different styles, from the fast-paced world of scalping to the patient game of position trading. But all of it, every last indicator, every news report, every strategy is filtered through you. You are the system. Your psychology is the operating system that runs the trading software. A flawed operating system will crash even the most brilliant program. The path to consistency in the Forex market is not an external one. It's not about finding a holy grail indicator or a secret strategy. It is an internal journey. It's a journey of building discipline, cultivating patience, and achieving a state of emotional neutrality in the face of uncertainty. It's about understanding that you cannot control the market, but you can, with great effort, control your reaction to it. This is the final and most important piece of the puzzle. Master your charts, understand the fundamentals, but above all, work to master yourself. Because in the end, the person staring back at you from the reflection on your monitor is your greatest ally, or your most devastating opponent. The choice of which one they become is entirely up to you. Continue your education, stay curious, and focus on the process. The potential outcomes will take care of themselves.